All right, so today is September 24th, 2024. And, if you just took a quick peek at the market, you might have just shrugged and thought, not much happened. But trust me, underneath that calm surface, some serious warning bells were ringing. Let's dig into what was really going on.
Okay, so let's get right into it. The big indexes, they all ended the day down just a little bit. But that tiny dip, it doesn't even begin to tell the real story. What we actually saw today was this massive tug of war. On one side, you had some companies with just incredible news, and on the other, some pretty big economic storm clouds gathering for everybody else. So let's look at the final numbers.
First, the S&P 500. It ended the day down just a tiny bit, 0.28%. Then you've got the NASDAQ, which is packed with all those big tech names. It dropped 0.34%. Now, that's its second day in a row of losses. And that's a big deal, because, that's where all the AI giants are.
And wrapping it up, the Dow Jones was down 0.37%. So, yeah, all three were down, but it was a pretty gentle slide across the board. Nothing too dramatic at first glance.
Okay, so this slide really gets to the heart of it. This was the big conflict of the day. You had this incredible positive force from specific companies getting just amazing news, sending their stocks to the moon. But then, pulling everything back down was this negative force. We saw a lot of people cashing in their profits on the big AI stocks, probably because they're getting a little nervous after Fed Chair Jerome Powell warned that valuations are getting pretty high. Right, so even though the big picture looked kind of sleepy, if you looked at individual stocks, whoa, the action was anything but quiet. It was explosive. Let's get into the headliners that really drove the action today.
I mean, just look at these numbers. It's wild. Unicor, up 250%, 250. That's because of some fantastic clinical trial results for its Huntington's disease therapy. Then there's Lithium Americas. It basically doubled, up 98%, after reports came out that the U.S. government is thinking about investing in its Navarre mine. Huge news. And in the tech world, Alibaba jumped over 8%. Why? They announced this gigantic $4 trillion AI investment plan. And not to be left out, Intel popped over 6% on a rumor that it's trying to get Apple to make a strategic investment. But like I said, it wasn't all sunshine. The copper giant Freeport-McMoRan got hammered, down 17%, because of worries about major production problems over in Indonesia.
Okay, so that's the story of the individual players. But while all that drama was happening, what was going on in the background? What were the big macroeconomic forces at play? Let's zoom out and take a look at the bigger economic picture. All right, there were basically three big economic signals flashing red for the stock market today. First, the 10-year Treasury yield, that's kind of the benchmark for interest rates, it was creeping up. Second, the US dollar was getting stronger. And third, oil prices went up. Now, why does this matter? Well, think about it. Higher borrowing costs, a stronger dollar, and more expensive energy, that's like a triple whammy that creates major headwinds for the stock market, especially for those high-flying tech stocks. And this quote, this was the comment that was just looming over the entire market. The head of the Federal Reserve, Jerome Powell, literally said the market is fairly high valued. Look, when the most powerful banker in the world says stocks might be too expensive, traders sit up and pay attention. And that's exactly what fueled a lot of the caution we saw today. And it's not just Powell's gut feeling, There's a famous metric that backs this up. It's called the Buffett indicator. And it basically compares the entire value of the stock market to the size of the US economy. And right now, it's at an all-time high. Historically, that's been a pretty reliable warning sign that things are getting a little frothy. All right, so let's put it all together. We've got conflicting signals everywhere, valuations that are making the Fed nervous, but also these pockets of just incredible growth. It's a confusing picture, right? So the big question is, how do you even begin to invest in a market like this? Well, let's break down a playbook with three possible paths you could take. So you can really think about this in three different ways, depending on your stomach for risk. First, you could go all in on AI. Second, you could play it a little smarter and follow the government's money. Or third, you could take the classic slow and steady approach. Let's look at each one. Okay, scenario one, the aggressive play. This is for the true believers, the people who are absolutely convinced the AI revolution has barely even begun. We're talking about making big, concentrated bets on the leaders, someone like NVIDIA, hoping for those huge, massive returns. But, and this is a big but, the risk is enormous. If this AI boom turns out to be a bubble, you could get seriously burned. All right, scenario two is a little more strategic. It's what we could call the government policy play.
Here, you're investing in companies that are getting a big boost from Uncle Sam. Think about Intel and all the money from the CHIPS Act, or a company like Lithium Americas that might get a huge government investment. The logic is pretty simple. Having the government in your corner can act as a nice safety net and really help a company's prospects. And last but not least, scenario 3, the steady conservative path. With this strategy, you're not even trying to pick the next big winner. Forget about that. Instead, you just consistently buy into the whole market through something like an S&P 500 ETF. The idea is to avoid the crazy ups and downs of single stocks and just capture the slow, steady, long-term growth of the entire US economy. So let's get to the bottom line. When you boil everything down that we saw today, you're really left with two completely different, totally opposing ways to look at this market. So what's the bull case? Well, the bulls will tell you we are just in the first inning of a massive long-term AI boom. Yeah, prices are high, but they say the incredible earnings and investment totally justify it. But then you have the bear case. The bears are saying, hold on, this is a classic bubble. They see all the hype, all the risky financing, and they think it looks a lot like the dot-com crash just waiting to happen again. So as we move forward, what should you really be keeping your eye on? There are two huge risks. First, the AI bubble could actually pop. People are starting to worry about how these companies are actually making money, and some are even whispering about circular financing. That's a scary throwback to the dot-com days, where companies just invested in each other to fake their growth. The second big risk, the Fed makes a mistake. If inflation just won't go away, the Fed might have to keep rates high and crush everyone's hopes for rate cuts. And that could be the thing that pulls the rug out from under this whole rally. And that all leads us to the ultimate question, doesn't it? Is this AI revolution so powerful, so game-changing, that it can just plow right through all these classic warning signs? Or is history about to repeat itself in a really big way? That, right there, is the trillion-dollar question everyone is trying to answer.